Bitcoin had rejected from its 200-day SMA. And we had also rejected from the rising parallel channel. And we're getting under the bull market support band. Okay? This is a pattern that we had seen very similarly in the previous market cycle. During the previous bear market, we had also first retested the 200-day SMA and got rejected by it, and that was in line with the third retest of the rising parallel channel. Then we, of course, fell under the bull market support band, and that what had led to the final move of the breakdown from the rising parallel channel into the next leg down move of Bitcoin to reach near its market lows, right? Right now, there's a very, very similar structure playing out, right? We have a parallel channel. We retested it for the third time, and this is 1, 2, and 3. The third time was coincided as well with the retest of the 200-day moving average and the rising parallel channel. We are falling under the bull market support band, and the next level to watch out for is, of course, the breakdown of the parallel channel, if that happens or not, and then there could be some continuation to the downside. So, dip, 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 something like that, right? Of course, you get some support here, and hopefully we find support at the next major moving average, which is the 300-week SMA. Okay. Now, this is what the price structure says. Okay, if we compare it to the previous market cycles and, of course, recency bias, we had seen something very similar play out here. Rising parallel channel, multiple retest, failed retest at the bull market support band, and of course fall under and breakdown of the rising here. In that case, it looked more of a rising wedge. Well, I believe there are 8 macro forces that are at play, which would not only coincide with a similar pattern to the previous bear market. Usually there's a price structure that plays out and there are some patterns, but usually those price structure come hand in hand with something in the macro, right? So the price structure tells you something is happening, but the macro tells you what is happening. And without understanding what is happening, it's really not, smart speculation on the markets, and I don't believe you would make smart choices. That's why I like to look at the price structure and then go and verify this information with the macro. What we're going to be discussing today is how high interest rates are putting pressure on risk assets such as Bitcoin, how there is a liquidity deceleration that nobody's talking about. So the Fed is reducing the rate at which they are purchasing treasury, so they are reducing the rate at which they're increasing their balance sheet, and this is very visible in the data they release. I put all that data into a chart so we can visualize it better and compare it to the previous market cycle as well. All right, this is going to be one of the most important gems of this video that you can take out. There's also higher inflation expectation. Sure, rising oil prices is really putting pressure on inflation, and we can see that in the headline and core inflation as well, right? This is headline, this is core inflation, and it's not a small move, right? It's a major move. That should be. We were going to check the implications of that if it goes down or high. So they are also rising treasury yields. I've been tracking this for a while, but this has hit the news recently because we have reached the levels at which we were. The last time we were at those levels was, of course, in the before the 2008 financial crisis, around 2007. Right? We're going to be discussing that. What's implications if the 2-year and the 30-year go together, and what's implication if they divert, which is a dangerous situation. The weakening S&P 500, all right, and we're of course going to be discussing the 4-year cycle that is not only visible in Bitcoin but also visible in the S&P. What's that snippet which now is surfacing the internet, but in reality, I've been tracking this way long time ago. And I'm happy that people are catching up to this, right? But it's a little bit too late, and I worry when enough people look at something, usually it diverts. So we have to be careful from that, right? It's not a gem anymore, that one. There's, of course, the strengthening DXY. And of course, if you put it on Bitcoin, you can see that there's huge correlation and cross-asset interdependence between DXY and Bitcoin. So rising DXY means falling Bitcoin, and a season for rising DXY. This analysis will hopefully seem useful. It has been very useful for me for a long time. I've been tracking this, and it has always proven useful to me. I hope it continues to be a good predictor of the market, or one of the variables. The Bitcoin cycle, we're going to touch on it a little bit, and if we have enough time, we'll talk about the technical indicators as well. So there's a lot to discuss, so I'm going to just get over them like quickly, just to give you all the pieces of the puzzle, and hopefully that will be like the baseline for you to do further research. Or we talk about all these factors on the channel a lot, so if you do subscribe, then you can get up-to-date videos on how those factors are in play, deeper dive, and forecast, right? The macro is usually what drives price, right? The price structure just tells you, hey, watch out, there's something to worry about, or there's something to be euphoric about, and it's also good for entries. But the macro is what usually is the keyword, is what successful market speculators rely on for their direction of bias, right? So first, we're going to discuss the higher interest rates. Everybody knows that higher interest rates are worse, right, for risk assets. That's very shallow knowledge. If you do not know that, then I do please hope you can do some research on that, because it's very, very essential. But that's only the top layer, right? But the next level is actually understanding the balance sheet of the Fed and their liabilities as well, right? But for interest rate, in terms of interest rates, seems to be that higher for longer is the new normal, and there are no reductions for interest rates in the future till a 6% chance the end of last year. I checked that yesterday, and I guess that was 25% chance, right? It's getting bad in terms of interest rates and liquidity. So quantitative tightening is going to continue, and that's reflected as well in their balance sheet that we're going to discuss in the next point. Right now, there's even expectations that we will raise interest rates by the start of 2027. Okay, and the market will reprice that. I think we are undergoing that repricing, because the odds here have shifted since the meeting of China with Trump, right? So that's one thing to worry about. Higher interest rates is usually bad for liquidity in the markets. It's more expensive to borrow. Businesses cannot expand and invest, and it will be also harder for consumers to borrow, and they cannot make their expensive purchases. Less revenue for businesses, and there are more layoffs, and that usually puts pressure on the economy, right? The next thing to discuss is actually the liquidity deceleration that the Fed has quietly started. All right, so I have not seen any news of this, but I came to it by chance when I was looking at their tariffs. Sorry for spelling. So yeah, when I was looking at their balance sheet. So this might be new to some people, but the Fed goes through different phases, which can influence and characterize current periods into different regimes, liquidity regimes, which in turn characterize the economic regime and the market cycle in whole. Like it gives you an indication where they think we are. They can influence the future, but they can also tell you we are here right now, okay? So if you go look at these periods, you will see there are some things that differ from time to time, right? For example, here they were buying 150 million, they're not buying 150 million, they're not buying, and what they're doing is this means they're purchasing treasury yields, right? Short-dated treasury yields operations. Small value operations is short-dated treasury yields. And that phase has ended around the end of 2025, and we started a new phase of emergency, not QE, but they had to do some kind of increase the liquidity in credit markets, because if you haven't heard, then there was some private credit problems, Blue Owl was collapsing, and a lot of similar corporations that do private credit lending have stopped their investors from withdrawing money or something like that. And of course, interest rates have skyrocketed for them, because people do not trust private credit anymore, and the banking industry is well connected into the private credit industry. So after 2008, they imposed some rules, so the banking industry does not do some dangerous lending for dangerous businesses. But the banking industry, of course, found a way around it, and that's where they started to invest in private credit companies that can give loans to dangerous companies. You know, like the same as the mortgage, Supreme Mortgage collapse, where banks were lending money to people who want for people who want a mortgage to buy a home, and they kind of lend it for risky people and bundled it together, and you know what happened. Risky mortgages, risky businesses. That's the difference. But that's the difference. The Fed has seen the weakness during that period, so they pumped a lot of liquidity. But what we're seeing here is they were injecting 40 billion, but then the regime has changed. It's 25 billion. And that wasn't so worrying at the start when I saw that, because that could, again, jump to 40 billion. Maybe they're just going to switch 25, 40 billion, which is not so bad. But what they did is 25 billion and 10 billion. So there's kind of, if you think of it as a meter, right, acceleration meter, you were driving 40 miles or kilometers per hour, and then you go down 25, and then you go 10. So what is that? The traffic light is soon, where we're going to have to stop. All right, and you will see that when we look at the chart. Okay, and about that, this is pretty constant. It changes on a little bit. Of course, it's included in the calculation all the charts, but the 40 and the 25 and the 15 billion is what changes, and it is what is so important. Okay, so here we're gonna have to keep it at the 12-hour. This is how it is viewed on the chart. Now we're gonna check this period, and then I'm gonna give you another period which is very similar, which happened in the previous bear market cycle around the same time. Okay? Yay. So first they were, of course, they did some quantitative tightening. They were buying around 150 million, right? This was just from market operations. So just greasing the wheel, making sure everything works in their operations. So they give out the money. By doing these constant operations, they make sure that the money goes to where it should go at the time it should go, and make sure that everything is working fine. So that's what the tactical operations means, right? But it also forms as the type of signaling. So here they were doing it constantly every day, of course, 5 business days a week. They were doing it every day, 7.5 million a day, right? The total period was the total amount was 1.5 billion for that whole period, okay? But here they switched their pace. They bought some time and they stopped some time. They bought some time and they stopped some time. What that shows is a shift in regime. It signals a more hawkish Fed. That's the signaling it gives. The amount is not as important in these operations. It is important, but not as important as the rate of change of their operations or what they're doing. Okay, so the rate of change is what gives the signal to the market. You can see here it was euphoric. You can see here a little bit of a cool down. You see a different regime. And then they stopped for a while, and then they just suddenly injected 2.7 billion a day, right? And what they said for that is they were worried about the banking industry, and they had to support it, which is true. But there's an indirect influence to risk assets. Whenever they do something, it trickles down to assets. So risk assets had that rally, which coincided with their market operations. But then, recently, they have reduced their market operations from 2 billion a day to 1.3 billion a day. And that's what we're trying to get at to. All right, so they reduced. They were constantly buying 2.7 billion a day. And then they entered a new phase where we go from 2 billion a day to 1.3 billion a day. Now, what's the next phase? It's important. Let's go to the previous bear market cycle. Here, they were doing something similar to here at a much larger amount. Okay, here they were doing around 4 billion a day. They're doing around 7.5 million a day. But what's important is the rate of change. Here they were still doing 4 billion a day, but there was a different regime with rising inflation and high liquidity and overheating economy, okay? But after that period, they had started to reduce their monetary injection into the system, right? They reduced the amount of their purchasing of treasuries from 3.5 billion a day to 1 billion a day. Okay? So first they were constantly buying treasuries, injecting liquidity into the market, indirectly or directly, it doesn't matter. It trickles down. Here it was direct. Here it wasn't direct during that phase. Okay? They're injecting, and then they switched to liquidity deceleration phase. All right? So here it's called the QE type of regime, usually, that regime specifically. They reduced from 3.5 to 1 billion. During that same phase that we had discussed just not long ago, right? Where we had rejected of the 200-day moving average, the rising channel, right? Rejecting from the top, and of course the bull market support band was somewhere here, and that's a rejection from here. Okay, if you just as a little refresher, right there. Okay. But what's important is, after they had reduced the accelerated, the traffic light came and they stopped, and they were doing not even market operations. They were doing nothing. They were giving no signal to the market. It was completely, we're going to dry all liquidity from the market, which is what happened. Okay? And then we transition to quantitative tightening here, and we come to here. So here's what's important. That same taper regime coincided with the same, approximately with the same period. All right? So if what comes after is we're stopping liquidity here, then that signals that the bear market is going to continue to much lower levels. Okay, that's what that tells us. But if they deaccelerate, something breaks, and they accelerate treasury purchasing again, then you might get some other structure that plays out where we can have continued rally because the Fed is indirectly injecting liquidity into risk assets. So if the Fed switches again to higher numbers than here, then that signals bullish for risk assets and equities alike. But if we stop or continue the acceleration, that will signal we are going down. More likely, that will give a higher probability for going down. So that's in terms of the liquidity, which I think is very a gem in the market that nobody is looking at on, at least on YouTube, right? The next one is higher inflation expectation. Okay, and this is where the regime starts to see some conflicting things, and more like it's like a macro checkmate. All right, we're getting some macro checkmate. We're getting higher inflation and higher interest rates. So if anything breaks, the Fed cannot really cut interest rates and save the economy, which can lead to bad things, right? In general, higher interest rates and higher inflation is bad for risk assets. Recently, inflation has skyrocketed, headline inflation. And we have seen that skyrocket because headline inflation includes calculation of energy, right? And when energy skyrockets, then it's really reflected in core inflation first, but headline inflation. And then core inflation sees it later, usually after 2 months of oil rising. And we had already seen that, right? We've discussed this before, that we will see core inflation be affected very soon. And if the trend continues, this can be very not good for risk assets such as Bitcoin. But if we see that core inflation starting to head down again, then that will be a bullish thing for Bitcoin. So here we're trying to give a more unbiased view. So what happens if this goes up? What happens if this goes down? But I will also give my opinion that I think core inflation and headline inflation will continue to rise. All right, just because of higher oil prices. But if consumer demand drops, then that will put inflation down, right, as well. So we need to also consider that factor. Oh, oil. Of course, we have to talk about oil a little bit. So oil just broke out of its pattern, that triangle pattern, and it seems that we do have momentum to the upside right now. unless we break that support line, and then that view may change. Now, if supply disruptions continue and the war, geopolitical tensions continue, then you can expect oil to remain within these levels until some resolve in geopolitics that can lead to break to the upside in either if it's war or break to the downside if the Strait of Hormuz is open, right? Upside for oil puts pressure on Bitcoin because that puts pressure on inflation itself. And I want you to understand as well, even if the oil war continues on, if consumer demand goes down, then oil will go down, okay? Because of the demand side going down. So oil is kind of influenced through supply and demand, right? Yeah. So if consumer demand stays strong and the geopolitical tension in the Strait of Hormuz escalates or remains, then we should see higher oil prices, or at least in the same level, which is bad for inflation, which is bad for risk assets such as Bitcoin. And tariffs, of course. Trump's tariffs, they are causing higher inflation as well. So right now, really, until anything changes in oil or tariffs or demand for oil, then inflation is going to be sticky for a bit. Rising treasury yields. That's a big one. That's a very big one. So if yields are rising up, what that tells you, it's bad for risk assets if the yields is rising. One, because basically anybody who wants to grow their money instead of putting it into Bitcoin, you know, which is risky and yeah, it may have high return, but it has high risk. They could put it in something like treasuries, which right now has 5%, right? If the stock market averages 7%, 5% is very good for a safe haven asset that you can somewhat guarantee that you get your money back to a certain degree. But 90%, 95%, it's safe, right? It's safe unless of course, something happens to the US or something like that, right? But I don't think that's anytime soon. So if that goes up as well, it's bad. We discussed why it's bad, but why it's going up is because could be several reasons. One of it is the 30 year, specifically the 30 year, is when investors worry about the fiscal health of the US. Now they demand higher returns on their lending for being a riskier, financial entity. So if somebody is more financially risky for a bank, then they would require higher interest rates, right? Similar thing to companies. That's one. Of course, rising debt. If somebody has a lot of debt, you want them to pay higher interest rates, right? Because they're riskier, right? Of course, we're seeing higher interest rates. We're seeing fiscal problems, blackout, private credit, and another one would be. Those are the important two, basically, debt and fiscal security. Oh, higher inflation expectation as well. If there's higher inflation expectation for the future, especially in the long term for 30 years, then people would demand higher return on their investment, just because inflation would be rising, and I want my true return need to be positive, right? It cannot be negative. If inflation is going up 4% a year, I would at least require 5% a year, right? If I get 3.5, I would lose money. The real interest rate, right? So those are the three factors why the 30 year is going up, which is, again, bad for risk assets because people place their bets here. Another one is the 2 year. Okay, the 2 year is usually on short-term problems. Okay, and now if the 30 year goes up, this is something very, very, I think, can be very useful for you for now or the future. This video is going longer, so we're gonna try to be fast, but it has a lot of information that I think is important, right? If the 30 year is going up and the 2 year is going down, right? That is usually bad. That is usually very bad. Because that prices near-term recession fears. Okay? Oh no. that prices in near-term recession fears. Okay. So if the 2-year it goes down, you have to consider if the 2-year goes down because there are recession fears. That's bad for Bitcoin because recession may be soon. It's one of the just the indicators before the recession happens, like in here, COVID-19, like in the supreme mortgage crisis. See, the 2-year debt went down, and that price in recession fears. And here as well, we can maybe check the 30-year to coincide. Some of those periods, not always, but some of those periods coincide with rising. Like here we stagnated, right? But the 2-year was going down. Here was going like here we went up, and then that kind of triggered some kind of the trigger there. So if that goes up or stagnates and the 2-year goes down, that's usually very bad. What I mean by go down is go down aggressively as well. Okay, while the other one just does almost nothing, right? See how it goes down aggressively? Okay. But again, if the 2-year goes up, then that's also bad for assets. I know, just I'll clear the point soon. But if it goes up, then people want to place their money in safer bets like the US government 2-year bonds, okay? So they would not choose Bitcoin as much. Now, if the 2-year just goes down because of, you know, a positive outlook of the economy for the US in the future, that's a good thing. That's a good thing that will put Bitcoin's price higher, okay? That's the only case I can think of right now. Weakening S&P 500. So, one thing about the S&P and Bitcoin, the relationship, is that even when the S&P goes higher, Bitcoin can go lower, okay? And if you look at such periods, right? For example, the December 2021, Bitcoin went down first, then the stock market saw some weakness, and they went down together. That usually works out a lot of the times. Similarly to the February 2018, it's a little bit different situation here. We went down very quickly, but the stock market had only seen weakness. It had not went down. So if you look here, we made, yes, lower lows, but we had also made higher highs in the same period. So we saw weakness, not a complete market collapse and bubble or recession, but Bitcoin had completely collapsed during that period. Okay, another period, which was weakness of the stock market during the, you see, the 4-year cycle is not only for Bitcoin, it also works for the stock market, as you can see some of the analysis I have done there. But the stock market doesn't have to crash or go down. The stock market only sees the weakness or crashes every 4 years. But Bitcoin senses it, right? Especially the best example is right here, during that period. Bitcoin went down during that 4-year period, right, around 2014, but the stock market had only stagnated, right? We went down, but we did not really see a recession or market collapse. We saw some weakness, but the Bitcoin saw a complete collapse. Sometimes they do have the recession periods together, like the previous cycle, right? And sometimes they don't. But every 4 years, the stock market around that time does see some form of weakness. And right now, that time of weakness is December 2025. Which just coincides with that snippet that if you take from the 2000.com bubble, right, which I'm sure a lot of people see, which stock market had been very receptive to it. And if it's not broken, don't fix it, right? I usually follow trends till they finally stop following that trend. And right now, the trend is intact. Of course, the stock market could see weakness, and then maybe the Fed start printing money, the macro changes, and we will see higher highs, right? Or maybe see the weakness here just in time, and then see the highs later. We could divert from that trend later. But right now, the signs do not show that there could be a diversion unless the money, something breaks in the economy and the Fed start to print some money during that period after the stagnation. I believe that would be the time for it after the 4-year weakness period has passed, which is 2026, right? But also we could follow that. But right now, in the short term, I do see that the stock market experiencing some weakness now, as we have reached the highs of that move, right? And there here shows that there should be some weakness. We had seen it here, and we had also seen it right here, right? We had been tracking it very well. So I believe that this could be another move that we could track in the short term at least, right? Until the stock market breaks that snippet, I'll probably continue follow it and like place some kind of probabilistic trust in it. Another one is the DXY. Whoa. The DXY is an interesting one. So usually when the DXY goes up, Bitcoin experiences weakness. So if you go and analyze all the periods of the before we actually look at, I want you to analyze the periods where the stock market actually DXY has went up or down. We get these periods, especially in recent history since 2015, where we do some ascending channel, we retest the top, we retest and fake out the bottom, and then we eventually break down and we consolidate before we continue higher. The red shows that it's bad for Bitcoin. That's why it's red. The green shows it's good for Bitcoin because falling DXY is good for risk assets such as Bitcoin. Rising DXY, which is the US dollar, is bad for risk assets and equities usually, such as Bitcoin and equities. You get that structure here, the rising wedge. You get the retest of the top, fake outs, up and down, and then a breakdown. And then you go down. After that period, we stabilize, and then we go to the upside. Sometimes aggressively, sometimes just slowly. We saw similar things here. Fake out below, fake out above, breakdown, good for Bitcoin, falling DXY, and then a rise at the top. So that plays out often in history. Okay, now our goal here is to predict where Bitcoin would go, right? Sorry, DXY would go. Just 1 second. The dog is barking too much. I'll come back. We are back. Hello. All right, let's focus. If the DXY goes up, is bad for Bitcoin. All right, if the DXY goes down, is good for Bitcoin. If it stagnates, then it's just a transitioning phase. Now what we're seeing is after the breakdown of the DXY from its upward channel, we stagnated a little bit, and we are forming a structure of a higher low that could lead to go to the upside. Okay? Now, here the thing is to watch is if we actually break above that channel, we retest and we continue up, then that's bearish for Bitcoin. Okay? If we get rejected, right? If we get rejected here and we go down, then break below and continue down, that's good for Bitcoin. But right now, the odds are in favor of the DXY going up based on its market cycle, right? Based on its cycle that it has played out since the longest time, right? And if you see in the red periods, that's where we get actually the bear markets for Bitcoin, right here, right here. And when the DXY rises just so slowly, right, you get that type of Bitcoin move that it really wants to go up, but it's feeling the pressure. But when it's fast, as so, which what I would prefer is you get the normal bear market and then you get the extension to the upside, right? That's what we want, like something that can fast down, fast up. Let's get it done with. not like the 2019 type of market, which was very stressful to trade, right? And seemed difficult. Yeah, let's delete that, that. And finally, the Bitcoin cycle. Now, the Bitcoin cycle is pretty important in many ways. And if something continues to play out in one way, then I think it can be probabilistically useful in trading and market speculation to follow that it's going to continue until it's broken, until it's proven that it had been broken. Okay, that's my personal opinion. And majority of my, like, if there was one factor that I can attribute to my success in market speculation, specifically for Bitcoin, is I would say I followed the market cycle. When everybody was like, no, the market cycle is broken, extended cycle, extended bear market, extended everything, it's not the time, I just stuck that the history will repeat until history stops repeating. And that proved very good. Especially if you look at, if you were looking at the market cycle and how history repeats, you would see the structure of Bitcoin on how it topped. You see the first top right here, see the second top right here, first top, second top, fall down. And even that period coincided very similar to that period and looks pretty much similar, right? So we're getting a lot of similarities between previous market cycle and this market cycle. And we topped around the same time, right? We topped in October, which was usually the time we top, November, October, December, sometimes January. But nevertheless, Q4 of the, midterm year, right? It's pretty simple. And the Bitcoin cycle, since it has been following the Bitcoin cycle, let's assume that if it continues to follow it, then the bottom really should happen around 364 days after the top, right? So that would put us around October. That means probabilistically the downside is more favorable and probabilistically higher, right? Than not. But if we see some strength and we break, for example, the 200-day moving average, and we break higher, and we form maybe a higher high here, then sure, the Bitcoin cycle is broken and probably should be taken with a grain of salt if it is to be followed again. I'll probably not follow it as much. I'll just look at it for inspiration, but not as to have a high probability as a factor in my trading strategy, right? Of course, nothing said in this video is financial advice. I hope you can just learn a few things and continue doing your own research before doing any serious financial decisions, right? So yeah, we had always bottomed around 364 days, but also the first market cycle was around 400 or something days. So it can vary, but it's around 364 days. Two bear markets had found it in 364 days, but one bear market had found it around 415 days. Now, this video is already long enough, so technical indicators, we had discussed them a little bit at the start of the video. So that's your 8 macro factors plus, like one technical factor that can influence the direction of Bitcoin, whether to the upside or the downside. I'm more lenient to the downside. But of course, I hope I am on the right side of the market. I'm just a market speculator. I do not really know what's going to happen. All I do is just research and make analysis and make probabilistic decisions based on the analysis and research. I hope my research has helped you. And if it did, please, please, please leave a like. It helps the channel a lot. And if you want to see more videos like that and discussing these factors in more depth, then do consider subscribing so you don't miss another video. I'll see you the next time. Thank you for watching. Bye-bye.